Welcome to Coin Pulse, your go-to channel for everything money. From crypto insights and stock trends to the jaw-dropping financial stories of the rich and famous. Stay informed, stay successful. Let's talk money. What's up today? Since Donald Trump's election, Wall Street has been on a wild ride. But what does it mean for us as investors? Today we're diving into the world of Trumponomics 2.0. What's driving the market rally? How could tax cuts, deregulation, and investments keep boosting the S&P 500? And what risks are lurking with rising debt, tariffs, and geopolitical uncertainty? We'll explore the winning sectors, risky bets, and why Tesla, Bitcoin, and gold are standing out in this critical moment. Stick around because by the end, you'll know how to position your portfolio to capitalize on the Trump era, or at least minimize the risks. Since the U.S. election, Wall Street has been in a celebratory mood. Will the rally continue after Donald Trump's inauguration on January 20th? Many signs point to yes, although the risks in the U.S. stock market are increasing. Today, Donald Trump officially assumes office as the 47th President of the United States. Financial markets have been celebrating since his election on November 5th. The S&P 500, the most important stock market index on Wall Street, has risen by over 6% at its peak. Since the election, American markets have reached new records, Trump said proudly shortly before his inauguration, promising a golden era for America. But will the Trump rally continue after January 20th? His agenda includes tax cuts, deregulation, and investment programs, all of which are positive for stock prices on Wall Street. On the negative side are tariffs, stricter immigration policies, and the unpredictability of Trump's actions. In other words, growth opportunities versus inflation risks. What this means for U.S. stock markets, what European investors should prepare for, why U.S. small-cap stocks look especially promising, whether U.S. Treasury bonds are worth it, why the rally in Bitcoin and gold continues, and what Tesla investors should watch out for. All of this will be explained shortly. Many people wished for a different election outcome. Trump, a convicted criminal, notorious liar, and open critic of democratic institutions, causes sleepless nights for the majority of citizens across the Atlantic. His press conference last week reinforced this sentiment. Jumping from low water pressure and showers to stranded whales, he quickly moved on to topics like reclaiming Greenland and Panama for the U.S., potentially through military force, as well as incorporating Canada as the 51st state. He also demanded NATO partners allocate 5% of their GDP to defense. Trump is back and so is the chaos, commented the New York Times. Yet a clear majority of Americans democratically elected Trump. Whether we like it or not, we must come to terms with him as president. This is particularly true for investors. Trump will play a decisive role in financial markets over the next 4 years. We'll find ourselves waking up and immediately checking our phones to see what he tweeted overnight. Now we'll also need to keep an eye on Elon Musk's tweets. Together, the two can send companies and entire industries soaring or crashing. There is still significant upside potential for U.S. indices, driven by upcoming tax cuts, deregulation, and the protection and promotion of specific industries, says an expert at DZ Bank. Jason Woods advises a more relaxed perspective. When Trump imposed tariffs during his first term, financial markets remained surprisingly calm, observes the chief strategist at Freedom Capital Markets. He believes this trend will continue. His advice: if you try to predict market reactions based on every Trump tweet or outrageous statement, you'll lose a lot of money. What happens on day one? Trumponomics 2.0 will focus on trade, immigration, fiscal policy, and deregulation. But it's hard to gauge the relative importance of each issue, analyzes Claudio Irigoyen from Bank of America. The impact on both the domestic and global economy will depend on how these priorities are balanced, their timing, and international responses, he says. On day one, Trump may issue executive orders addressing tariffs, deregulation, and immigration, expects Bob Michel. But even then, it will take up to a year for these measures to take effect, notes the global head of fixed income at J.P. Morgan Asset Management. The issue? Markets are currently pricing in the assumption that all measures will be implemented in the first quarter, warns the expert against over-optimism. In our base scenario, Trump will impose tariffs on China and other countries, but at rates lower than the 60% and 20% he campaigned on, predicts BofA expert Irigoyen. Furthermore, the new administration is expected to restrict immigration, implement debt-financed tax cuts, and deregulate, particularly in the banking and energy sectors. Growth and optimism in 2025 will primarily be fueled by the new administration's efforts to deregulate and increase government efficiency, predicts Jonathan Curtis. In line with Reagan-era policies, the current approach aims to dismantle bureaucratic hurdles, streamline public spending, and slim down federal agencies, notes the CIO of Franklin Templeton. This should create a business-friendly environment that fosters competition, reduces compliance costs, and promotes innovation, he says. Alongside deregulation, Trump aims to ease the tax burden on U.S. businesses. The flip side? It will be costly for taxpayers in the short term. Growth effects will take time to materialize. In 2024, the national debt likely reached 6.4% of GDP. Net interest payments now account for 19.3% of tax revenues and are rising. Fiscal support for U.S. consumers is reflected in strained public finances, just days before the return of a president who shows little inclination toward moderation, warns Guy Wagner, chief investment officer at the fund company BLI. Dangerous 5%. U.S. bond yields are nearing the 5% mark. Historically, such levels have triggered significant corrections in equity markets. Yields on 10-year U.S. Treasury bonds have risen significantly since December due to investor concerns over debt-financed tax cuts in Trump's second term and the potential worsening of debt issues, analyzes Lisa Chalette. The dollar has been the primary beneficiary, explains the Morgan Stanley wealth management expert. Despite the risks, most U.S. investment banks remain optimistic about the stock market. Year-end forecasts for the S&P 500 reach as high as 7,100 points, a gain of over 20%. If the growth-promoting elements of Trump's agenda dominate, we anticipate higher real interest rates, slightly increased inflation expectations, a strong dollar, and a strong stock market. Demand should remain high due to geopolitical risks, predicts BofA expert Irigoyen. If you enjoyed the video, give it a like, subscribe to the channel, and hit the bell so you never miss a trend. Stay informed, stay successful. See you soon.